What's going on, guys? Welcome back to day 18 of the mentorship. So if you haven't watched the previous videos, the last 17 days pretty much, make sure to go ahead and watch those because, it's just the best thing you can do at this point. Go from day one and watch all the way up to now. So with that said, make sure to leave a like on the video, subscribe to the channel if you haven't already, leave a comment down below, whatever you want to do, okay? So in today's video, we're going to be going over how to identify fair value gaps that actually work. Now, I know a lot of people, talk to me, they DM me, they do whatever, and they ask me like, oh, well, I take this for value gap, it goes in my direction for a little bit and then ends up just stopping me out. There's a lot of things that you need to understand in terms of how fair value gaps work and how they work in relation to a drawn liquidity or just a strong point of interest that price likes to draw towards, okay? So real quick, let me just draw this out and I'm gonna show you exactly how the market moves. So for market maker buy model, you're gonna have something like this, okay? It's going to have legs of accumulation, which distribute, more legs of accumulation distribute, and then you're going to have a point of reversal at where the trend is now done, which will then do this, and then you'll have basically a bearish move now off of that bullish move. Within these bullish moves, you're going to have fair value gaps inside of these. You might have 4, 5, 6, whatever. It all depends on what time frame you're on. You might have one here, you might have one here, one here. It all depends on where you are. A lot of the times I see people wait for a tap into a fair value gap and then that ends up coming down and stopping them out. Now, why is that? Most of the time, if you're entering on a fair value gap that is in the opposing draw of liquidity, you're obviously going to get stopped out if the drawn liquidity is lower. Now, what you should be doing instead is overall figuring out where the drawn liquidity is by making the most sense in terms of logic and overall narrative on the chart. So there's two types of fair value gaps. You have your normal fair value gap, which you usually get a tap in towards, and then it decides to go to wherever drawn liquidity it wants to go to. And then you have an inversion fair value gap, which basically means you're going to have a bullish gap, let's say in this scenario here, and price will actually close through it, and then it will retest, and then it will decide to trade back lower after retesting that if the drawn liquidity is lower, okay? And conversely, if you look over here, let's say you have bearish gaps in here, they will respect, bearish gaps will respect, bearish gaps will respect, right? But what's not going to respect? Bullish PD arrays. If there is a bullish fair value gap in here, it's going to get ran through and then traded back up into most likely, and then continue on in the direction of the drawn liquidity. So if we go to some live examples here, we can see exactly what I mean. So you can notice here, okay, we have two fair value gaps. We have one here, we have one here, and then on the 2-minute time frame, it's just one big fair value gap, okay? A lot of the times people might see this, right? It's trending higher. What are we doing? Okay, we're putting in higher lows, we're putting in higher highs. A lot of people would expect we might tap into this fair value gap, maybe the second one, and then trade higher off of that. But in this case, we had an SMT in a higher time frame. We were rejecting off a higher time frame key level. So in this case, we were reacting off this hourly fair value gap, if we can draw that over there. And you can see exactly what I mean by longing this wouldn't really necessarily be the smartest move. But instead, we use these as an inversion. So if you hop down to the 2-minute time frame, you'll notice that we actually inverse that while at the same time creating a change in state of delivery. Okay, we have your breaker right here. Price trades back up into this breaker, and then ultimately draws towards equilibrium of this range right here, which we do get that tap. That's just overall the general preface of what I mean, why every fair value gap doesn't work. You have to wait for that actual key level to get hit, and then from there, if you are bearish, you can expect bullish PD raise to fail and bearish PD raise to hold. So do we see any fair value gaps here on the 1 minute? No, it's all pretty much balanced price action. But what happens at this point? We hit our key level here, equilibrium. We have an SMT at the lows. We do have another SMT here with these two lows. And guess what? Right, look at this. We have a bearish gap, it gets disrespected, retests, trades higher, right? And then we have another fair value gap here that does get inversed, but the draw is higher, so it fails, right? There's all these different fair value gaps, ones that will either inverse or ones that will tap, that will fail if you're not in the correct direction of the drawn liquidity. So you can see here we actually do leave this gap behind. Now, why is that? A lot of the times, if we do leave a gap behind, that means either ES came in and tapped the gap, or it's just a lot of displacement and there's no need to reach back into there because we want to leave a breakaway gap and all the liquidity was already taken out, which means price doesn't really need to necessarily come back and tap that area of interest. And you can see here we do have a 1-minute gap here, which does get tapped. It's very small, but since the direction of the drawn liquidity is bullish and we've managed to hit all our key levels, that is going to hold, sending price up towards this area here and then obviously higher towards the end of the day. So that's really all I got for finding right fair value gaps and how to avoid the ones that don't work. Just don't trade in the wrong direction of drawn liquidity, okay? Again, if we are bullish, we will disrespect bearish PD arrays and we will respect bullish PD arrays. And conversely, if we are bearish, we will disrespect the bullish PD arrays and respect bearish PD arrays, just like how we respect this mitigation here, and that trades price lower towards these draws, and then now that's point of reversal. So yeah, that's pretty much all I got for you guys. If you have any questions, if you have any comments, leave them down in the comment section below. Leave a like on the video as well. I hope this was informative enough for you guys. I tried to keep it as simple as I possibly could. But yeah, with that said, I'll leave you boys with that, and I will catch you guys tomorrow for day 19. Peace.